I need to warn you about something that's happening right now in the precious metals market. And I'm not being dramatic when I say you have a very narrow window to act. Let me paint you a picture of what's unfolding. Central banks just completed their third consecutive year of buying over 1,000 tons of gold. Think about that for a second. The institutions that print money, that control monetary policy, that have access to every economic indicator you can imagine, they're converting their own currencies into gold at a pace we haven't seen since the 1970s. India's central bank, Turkey, Poland, China, though they're not telling us the full story there. These aren't small players making emotional decisions. These are the people who see the data before anyone else does. Now here's where it gets interesting. While they're accumulating, something else is happening in the physical market that most people aren't paying attention to. The spread between paper gold and physical gold is starting to widen. You know what that means? It means the paper market, the futures contracts, the ETFs, they're becoming disconnected from the actual metal. I've been watching this market for years, and I can tell you, when that spread widens, it's like watching a crack form in a dam. Everything looks fine until suddenly it's not. Let me take you back to a moment in history that rhymes with what we're seeing now. August 1971. Nixon closes the gold window. The dollar is no longer convertible to gold. What happened next? Gold went from $35 an ounce to $850 by 1980. That's not a typo. A 24 times increase in less than a decade. But here's what most people don't know about that period. The smart money, the people who understood what was happening, they didn't wait for gold to hit $850. They acted in 1971, 1972, 1973. They accumulated while everyone else was still trusting the system. Right now, we're in a similar moment. The difference is, this time, it's not just the United States. It's the entire global monetary system that's under stress. The dollar's reserve currency status is being challenged in ways that would have been unthinkable 20 years ago. BRICS nations are settling trade in their own currencies. Saudi Arabia is accepting yuan for oil. The world is slowly, methodically, moving away from dollar dominance. And every time that happens, every time there's another announcement about bilateral trade agreements that bypass the dollar, gold moves higher. But let's talk about something even more immediate. The supply situation. Gold production peaked in 2018. We're not finding new deposits at the rate we used to. The easy gold has been mined. What's left requires more energy, more capital, more time to extract. Meanwhile, demand is accelerating, not just from central banks. Industrial demand for gold in electronics, in medical devices, in aerospace, it's growing. Jewelry demand in Asia remains strong. And then you have investment demand, which is starting to wake up. You know what happens when supply is constrained and demand is rising? Basic economics. The price has to adjust. The only question is, how fast and how far? Now, I want you to think about your own situation for a moment. If you're holding significant wealth in dollars, in bonds, in traditional assets, you're essentially making a bet. You're betting that the system remains stable, that inflation stays under control, that the dollar maintains its purchasing power, that governments don't continue printing money to service their debts. Is that a bet you're comfortable making? Because here's what the central banks are telling us with their actions. They're not comfortable with that bet. They're diversifying. They're buying gold not because they think it's going to make them rich, but because they understand it's insurance against the very policies they're implementing. Think about that irony for a second. The people printing the money are buying gold to protect themselves from the money they're printing. Let me tell you about something that happened recently that didn't get much attention in the mainstream media. The COMEX, the major futures exchange where gold is traded, they had to increase margin requirements. You know why? Because the volatility was getting too high. Because the price swings were becoming too violent. That's not normal market behavior. That's stress. That's the market trying to find a new equilibrium. And here's the thing about these moments of transition. They don't last forever. There's a window where you can still act, where you can still position yourself before the crowd figures it out. But that window closes fast. I've seen it happen before. In 2008, when the financial crisis hit, there was a brief moment where gold actually dropped. People were selling everything to raise cash. But if you understood what was happening, if you understood that the response to the crisis would be massive money printing, you knew that dip was a gift. Gold went from $800 to $1,900 in the next 3 years. The people who acted during that window, who bought when everyone else was panicking, they did very well. The people who waited, who wanted to see more proof, they ended up buying at much higher prices. Right now, we're in one of those windows. The signs are all there. Central bank buying, supply constraints, geopolitical tension, currency debasement, debt levels that can never be repaid with sound money. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, you should know that you can hold physical gold in those accounts. It's called a gold IRA. I put together a free guide that explains exactly how it works, how to do it without tax penalties, what the rules are. It's in the description below. Worth looking at if you're thinking about protecting your retirement savings. All right, back to what's happening in the market right now. Silver is another part of this story that people are sleeping on. Silver has industrial applications that gold doesn't. It's used in solar panels, in electric vehicles, in 5G infrastructure. The green energy transition alone is going to require massive amounts of silver. But here's the problem. The silver market is tiny compared to gold. The entire above-ground supply of investment-grade silver is worth maybe $50 billion. That's less than the market cap of many individual companies. If even a small percentage of global wealth tries to move into silver, the price impact would be enormous. And silver has this historical relationship with gold, the gold-to-silver ratio. Throughout history, it's averaged around 15-1. Right now, it's around 80-1. That means silver is either dramatically undervalued relative to gold, or gold is dramatically overvalued relative to silver. Given what we know about industrial demand for silver, given the supply constraints, I think we know which way that ratio is going to move. Let me tell you about a conversation I had with a mining executive recently. He told me something that stuck with me. He said, "We're not finding new deposits. The geology isn't there. And even when we do find something, it takes 10 to 15 years to bring a mine into production. The silver we're going to have in 2030 is basically already determined." Think about that. The supply is essentially fixed for the next decade, but demand is accelerating. Electric vehicles need silver. Solar panels need silver. Electronics need silver. And now, investors are starting to wake up to the supply-demand imbalance. What do you think happens to the price? Now, I want to address something that I hear all the time. People say, "But gold doesn't pay interest. It doesn't generate cash flow. Why would I own it?" That's the wrong way to think about it. Gold isn't an investment in the traditional sense. It's not supposed to generate cash flow. It's supposed to maintain purchasing power. It's supposed to be the asset you own when everything else is losing value. When currencies are being debased, when governments are running deficits that can never be closed, when central banks are trapped in a cycle of money printing, that's when gold does its job. And right now, we're in exactly that environment. The U.S. national debt is over $30 trillion. The interest payments on that debt are becoming one of the largest line items in the federal budget. How do you think that gets resolved? Do you think they're going to cut spending? Raise taxes enough to close the gap? Or do you think they're going to do what governments have always done throughout history? Print money, debase the currency, inflate away the debt. If you understand that's the path we're on, then you understand why gold is moving higher and why it's going to continue moving higher. Let me give you another historical parallel. Weimar Germany in the 1920s. Everyone knows about the hyperinflation, the wheelbarrows of cash to buy bread. But here's what people don't talk about. In the early stages, before it got really bad, there were people who saw it coming. They converted their marks into hard assets, into gold, into real estate, into foreign currencies. Those people preserved their wealth. Everyone else got wiped out. Now, I'm not saying we're headed for Weimar-style hyperinflation, but I am saying that the purchasing power of the dollar is being systematically destroyed. It's happening slowly enough that most people don't notice. But if you look at what you could buy with $100 20 years ago versus what you can buy today, the trend is clear. And it's accelerating. The money supply has exploded over the last few years. That money doesn't just disappear. It shows up somewhere. Sometimes it's in asset prices. Sometimes it's in consumer prices. But it always shows up. Gold is how you opt out of that system. It's how you say, "I'm not going to let my wealth be eroded by monetary policy I have no control over." Here's something else that's happening that most people aren't aware of. The physical gold market is getting tight. Dealers are reporting longer wait times for delivery. Premiums over spot price are rising. That's not normal. That suggests that demand for physical metal is outstripping supply. And remember, most of the gold trading that happens is paper gold, futures contracts, ETFs, unallocated accounts. Very little of it is actual physical metal changing hands. But when people start demanding physical delivery, when they stop trusting the paper promises, that's when the system gets stressed. We saw a preview of this in 2020. When the pandemic hit, there was a brief moment where you couldn't buy physical gold at anywhere near the spot price. Premiums went through the roof, dealers were sold out, the paper price and the physical price diverged significantly. That was a warning shot. It showed us what happens when everyone tries to get physical metal at the same time. The system can't handle it. Right now, we're seeing early signs of that same dynamic. It's not as extreme as 2020 yet, but the trend is there. Physical premiums are rising, delivery times are extending. The smart money is taking delivery now, before it gets harder. Let me talk about something that doesn't get discussed enough: the role of gold in the international monetary system. For years, people have been saying gold is a barbarous relic, that it has no place in a modern financial system. But central banks never stopped accumulating it. They never stopped treating it as a reserve asset. Why? Because gold is the only asset that's not simultaneously someone else's liability. When you own dollars, you're trusting the US government. When you own euros, you're trusting the European Central Bank. When you own bonds, you're trusting the issuer to pay you back. But when you own gold, you're not trusting anyone. It's no one's liability. It can't be printed. It can't be debased. It just is. That's why central banks hold it. That's why they're accumulating it now. They understand that in a world of competitive currency debasement, in a world where trust in institutions is declining, gold is the ultimate reserve asset. And if central banks understand that, shouldn't you? Here's what I think is going to happen over the next few years. I think we're going to see gold break out to new all-time highs and keep going. I think we're going to see silver outperform gold as the industrial demand story becomes impossible to ignore. I think we're going to see more and more people wake up to what's happening and try to position themselves. And I think the people who act now, who understand the opportunity in front of them, are going to look back on this moment as one of the best financial decisions they ever made. But here's the thing: you have to act. You can't just understand the thesis intellectually and then do nothing. You have to take action. And the time to act is now. Not when gold is at $3,000 an ounce and everyone is talking about it. Not when silver has doubled and the mainstream media is finally paying attention. Now, when you still have the opportunity to position yourself ahead of the crowd. Think about your portfolio. Think about your retirement accounts. Think about the wealth you've accumulated over your lifetime. Is it protected? Is it positioned for what's coming? Or are you fully exposed to the dollar, to the bond market, to assets that depend on the system remaining stable? Because I can tell you, the central banks don't think the system is going to remain stable. That's why they're buying gold. That's why they're diversifying away from dollars. They see what's coming. The question is, I'm not telling you to put everything into gold and silver. That would be foolish. But I am telling you that if you have zero exposure to precious metals right now, you're taking a massive risk. You're betting everything on the system. And that's a bet that even the people running the system aren't willing to make. So here's what I want you to do. Take a serious look at your situation. Look at your assets. Look at your exposure. And ask yourself honestly, am I protected if things go wrong? Am I positioned to benefit if the monetary system continues down this path? If the answer is no, then you need to act. You need to allocate some portion of your wealth into hard assets, into gold, into silver, into things that can't be printed, that can't be debased, that have held value for thousands of years. The window is open right now, but it won't stay open forever. These moments of opportunity, they close fast. And when they close, when the crowd finally figures it out, it's too late to get in at reasonable prices. Don't be the person who looks back in 5 years and says, I knew this was coming. I understood the thesis, but I didn't act. Be the person who took action, who protected their wealth, who positioned themselves for what was coming. Because this isn't just about making money. It's about preserving what you've worked your entire life to build. It's about making sure that your retirement is secure, that your family is protected, that you're not at the mercy of monetary policy decisions made by people who don't have your best interests at heart. The central banks are showing you what they're doing. They're buying gold at record pace. They're diversifying away from dollars. They're preparing for a different monetary system. Are you going to follow their lead? Or are you going to ignore the warning signs and hope everything works out? The choice is yours. But the clock is ticking. And every day you wait, is a day closer to the window closing. This is your 24-hour warning. The people who understand what's happening are acting now. The question is, will you be one of them?